now move into the analytic and intelligence segment of today's webinar. Joining us next is a market specialist who closely tracks the lead and zinc value chain, trade flows, pricing behavior, and global market movements. Mr. Rounak Gairarey, Senior Analyst, Lead and Zinc uh, Value Chain from BigMint. Let's have your analysis on lead market.
Good afternoon, everyone, and welcome to today's webinar. Thank you, Beena ma'am, for the introduction. Before we dive into today's presentation, let me quickly take a minute to tell you what BigMint is all about. BigMint is a trusted platform that provides price reporting, market intelligence, and consulting specifically for commodities. We cover a wide range of markets like ferrous, non-ferrous metals, coal and energy, scrap recycling, logistics, and agriculture. Our services include price indices, future data, news and insights, reports, tenders, events, consulting, and even price forecasting. Everything you need to stay on top of commodities market. So before we dive in, let me quickly walk you through the 5 topics we will be covering in today's session so you all have a clear roadmap. Lead LME now at $1975, volatility rising, supplying surplus narrowing. Let's begin with the LME lead price picture. The LME 3-month average for December in the last 6 months was $1,975 per ton, and importantly, that is down 1.5% versus the last 6 months, shown here in red, which reflect the bearish pressure from rising inventories and a projected global surplus. Realized inventory has climbed to 20% on a 90-day basis for 2026, up from 17% in 2025. That rising volatility number matters because it tells you this market is not in a comfortable range. Unexpected events are moving prices sharply in both directions. Now let me walk you through the picture chart from September 2024 to May 2026. There are 3 key events I want you to notice. First, October 2024, EU battery recycling regulation hit the market and caused a brief rally as European recyclers scrambled to secure compliant feedback. Second, May 2025, the sharpest move on this chart, a sudden fall of $1,837 per ton following the US tariff hike announcement. That was the low point of the cycle and shook a lot of market participants. Third, November 2025, LME inventories jumped to around 40,000 ton in a single week in week 46. That inventory build pushed the 3-month contract lower and is still influencing market sentiments today. As of 27 May 2026, the 3-month contract closed at $2018 per ton. We are essentially consolidating in the range of 1900 to 2050 range. Now the regional premiums table at the bottom right. This is critical for India focused participants. India West Coast CIF premium is at $150 to $160 per ton over LME, steady and the highest of any region shown here. This elevated premium reflects India's domestic supply surplus situation, where recyclers are producing more than current consumption requires, but quality differentials and logistic cost keep import flows active. Southeast Asia at Singapore is rising at $130 to $135, driven by Chinese export push. Europe at Rotterdam is also rising at $130 to $140 due to energy cost pressure. Now, the 5 price drivers on the left side of the slide. First, lead acid battery demand from the auto replacement market. Replacement demand from automotive and backup power sectors continues to provide a structural demand. This is not a growth story, but it is a stable base. Second, scrap availability and secondary lead supply. Higher battery scrap recycling may increase supply and cap price in the short term. Watch Q3 when post-monsoon scrap collection typically surge in India. Third one is the LME warehouse stocks and market surplus, elevated warehouse stocks, and the 1,09,000 ton global surplus forecast are keeping prices bound. This is the primary bearish overhang on the market right now. Fourth, China demand and smelter production. Chinese smelter output, battery production volumes, and environmental policy enforcement will be the key swing factors through H2 2026. Fifth is macro factors that USD strength, US interest rates, and overall base metal sentiments will continue to drive price volatility independent of lead specific fundamentals. Bottom line, this is the range bound market with a bearish surplus overhang but a solid demand floor from batteries. Active hedging strategies are more important than ever in this environment. Now let me show you the underlying ILZSG supply demand data that is driving the surplus narrative. Global lead demand supply balance. This slide is one of the most critical for understanding where the structural story stands. The bar chart of the left shows the ILZSG surplus and deficit position from 2020 through the 2026 forecast. In 2022, the market was in a deficit of 1,77,000 tons. That was the tightness year in the recent cycle, driven by post-COVID demand recovery and mine disruptions. Since then, the market has swung back into surplus territory, and for 2026, the ILZSG is projecting a surplus of 1,09,000 ton. Now, before anyone takes that as a bearish signal, let me put this in context. The 2025 surplus was 70,000 ton. The market has been absorbing that through inventory drawdowns. LME stocks are still historically low, and the real question is whether 2026 production actually delivers the expected output, especially from Chinese smelters and Indian secondary producers. The table on the right gives you the world refined lead supply trends from 2020 to 2025. Total refined lead production hits 13.6 million tons in 2025, a 4% increase year on year. Mine production has been relatively flat, hovering around 4,500 to 4,600,000 tons. The insight here, production growth is coming from secondary recycling, not mining. And that is the structural shift that defines the next decade for our industry. Now let me move to the macro environment and what's driving lead demand globally. Global economy and lead market linkage, macro indicators and production data. These slides give you two things, the macro backdrops that shapes lead demand and the actual refined lead production data from 2021 to 2025. Let me start with the 5 macro indicators across the top. Global GDP growth is forecasted at 2.9% in 2026 by the IMF, modest but positive. For lead, this means steady battery replacement demand without a demand surge. China's PMI manufacturing came in at 50.4 for March 2026, back in expansionary territory. This is a positive signal for Chinese domestic battery consumption, but it is also means Chinese smelters will ramp up output, which has implication for export competition. Now, India auto production is up 11.8% year on year in FY 2026. This is the single most important demand driver for lead in India. More vehicles on the road today means more batteries entering the replacement cycle in 3 to 5 years. This is the structural demand floor that protects the India lead market. US Fed fund rate is at 3.64%, targeting 3.50 to 3.75%. The easing cycle reduces the cost of holding commodity inventories and generally supports base metal prices. Brent crude at 94 as of now barrel in is important because energy account for 25 to 30% of secondary lead smelting cost. Stable energy prices means more predictable smelter margins. Now the demand split pie chart on the left. Automotive batteries dominated at 52% of global lead consumptions. Industrial batteries at 22%, energy storage at 11%, alloys at 9%, and telecom and UPS at 6%. This composition explains why the auto sector macro data matters so much to everyone in this room. The production data on the right shows global lead refined output reached 13.6 million ton in 2025, up to 2.2 year. China produces 5.4% million tons, 40% of global output, growing at 3%. India is the third at 1.5 million tons, at up by 5%, the fastest growth rate of any major producer. Europe and the United States are flat to declining. The key message here, India is the growth engine for global secondary lead. The question is whether Indian producer can scale fast enough to meet domestic demand. Let me now take you into India's specific supply demand balance. India, here, this is India led supply demand balance. This is arguably the most important slide for everyone operating in the Indian market. Look at the bar chart carefully. India produces 1.4 million tons of refined lead domestically, but India also imports 0.43 million tons and exports 0.41 million tons. So it is simultaneously the major importer and the major exporter. How is that possible? The answer lies in quality and geography. India imports high purity refined lead and lead considered for the specific industrial application, while exporting lead that meets certain specification to regional markets in South and Southeast Asia. The net position is that India consumption at 1.4 million tons equal production, but the significant gross trade flows on both sides. This means disruptions is either important availability on export demand can create sharp price move in the domestic market. Now look at the sector-wise consumption. Table on the right, batteries account for 80% of all lead consumed in India, compromising both automotive and UPS batteries. This is even higher than global average of 74%, which reflects India's very high dependence on lead acid battery technology across the transport, power backup, and telecom sector. Cable sheeting takes 6% pigment and compounds 5%. Ammunition 3%, alloy 4%, and other applications are is around 2%. What did this tells you? India's lead market is essentially a battery market. When battery demand is strong, lead demand is strong. When battery manufacturer face raw material pressure, the entire lead value chain fails it. The scrap availability constant is critical to understand. India's 1.4 million tons of production is almost entirely secondary from used lead acid batteries. The collection rate for a used battery in India is around 85% to 90%, better than many markets, but not good enough to eliminate the supply gap. 10 to 15% that leaks into the informal sector or is not collected is the constant that keeps India import window structurally open. For traders and importers in this room, the import arbitrage window opens whenever domestic premium exceeds the cost of importing at LME plus $85 to $110 plus duties. Monitor the Mumbai CIF premium weekly. That is your signal. And we have looked at the market structure and the data. Now let me close with the 6 critical signals you need to monitor for the rest of the 2026. These are the 6 important critical signals every lead market participant must monitor in 2026. This final data slides is designed to give you a practical watch list for 2026. Let me take you through each of the 6 points. First, EPR enforcement crackdown, high risk. The Central Pollution Control Board is tightening enforcements of the battery wastage management rules, now compliant processor, primarily in the informal sector, are facing closure orders. This is structurally positive for organized recycler who have CPCB compliance and EPR registration. Watch for a quarter to 2026 consolidation wave where informal sector's capacity exists and organized players absorb the scrap at improved margins. If you are an organized smelter, this is your moment to lock in scrap collection contracts. Second, Chinese export policy shift, price mover. China exported around 2 lakh tons of refined lead in 2025. Any reversal of the export rebate policy, which Ministry of Commerce has been reviewing, would flood Southeast Asia with cheap material and pressure Indian import parity. Monitor Ministry of Commerce announcements monthly. If China reduces exports incentives, Indian producer benefits. If China increases exports, Indian importers benefits, but domestic producers face pressure. Third is scrap price volatility. Used battery scrap is currently trading at 70 to 75% of refined lead value, historically the highest ratio in recent years. This means smelter processing margins are compressed. Any demand slowdown, even a minor one, would cause a sharp correction in scrap prices and dramatic improve secondary smelters profitability. Watch the scrap to metal spread monthly. Fourth is AGM, absorbent glass mat. This is new one. Battery demand surge. Start-stop vehicle technology requires AGM batteries that use 2 to 3 times more lead than conventional SLI batteries, as Indians BS7 emission standards and Europe 7 compliance requirements come into force for premium vehicles. AGM battery demand will set up sharply. Battery manufacturers who position for AGM production now will capture premium margins. And fifth one is new smelter capacity ramp up. Approximately 300,000 tons of new secondary lead capacity is scheduled to commission in India before end 2026. Watch for commissions delays, permitting bottlenecks, right? Power availability and scrap feedbacks shortage as the three most common causes. If this capacity comes on delays stream as planned, domestic supply pressure eases. If it is delayed, India's import dependency continues and premiums stay elevated. Now, the last one is the INR USD exchange rate import cost. Every 1% of depreciation in a rupee raises the import parity of lead by approximately 2 rupees per kg, with eliminating import accounting for 12% of Indian supply. Currency movement directly impact end user cost. A weak rupee is good for secondary Indian producers competing against import, but bad for battery manufacturer who needs imported materials. To summarize, the three threats to monitor most closely are EPR enforcements, Chinese export policy, and the scrap price volatility. The two biggest opportunities are AGM batteries demand and being ready to capture market share from informal sector closer. And we are hosting the BINF 2026 and Global Commodity Conclave 2026 on 12th to 14th August in Mumbai, bringing together the entire non-ferrous metals and recycling ecosystem to discuss market outlooks, trends, and opportunities in depth. Looking forward to see you all in Mumbai. Thank you all so much for your time and your attention, and have a great day. Thank you.